What's up everyone, and welcome back to Explain the Charts. Today is October 22nd, 2025, and we are diving deep into Bitcoin as it sits at a critical juncture. The market is sending extremely mixed signals after a violent crash from all-time highs, a powerful rebound, and now a period of intense uncertainty. In this video, we'll first cover the headline news causing this volatility, and then we will jump into the daily, hourly, and 15-minute charts to break down the price action and map out what could happen next. Let's start with the macro environment, because it has been a whirlwind. Just a couple of weeks ago, on October 6th, Bitcoin was soaring, hitting a new all-time high above $126,000. However, that celebration was cut short by fears of a renewed US-China trade war, which reportedly triggered a massive flash crash on October 10th. That event wiped hundreds of billions from the crypto market and sent Bitcoin's price plunging below $105,000 in a matter of hours. The fallout has been significant, leading some prominent analysts to call the end of the bull run and even predict a prolonged bear market with targets as low as $70,000 to $80,000. This bearish sentiment was reinforced by massive outflows from spot Bitcoin ETFs and huge liquidations of leveraged long positions, suggesting a major risk reset. The Crypto Fear and Greed Index has also plunged into fear territory, reflecting the shaky confidence among market participants. But just as the bears were getting comfortable, a wave of incredibly bullish news hit the market. The most significant development came from U.S. Federal Reserve Governor Waller, who announced a skinny master account program. This is being hailed as a landmark policy shift, giving fintech and digital asset firms direct access to the Fed's payment systems and signaling a major step towards regulatory acceptance in the U.S. This news was a primary catalyst for the strong rebound we saw, with prices surging back past $113,000. Adding fuel to this fire is the narrative of a great capital rotation. Spot gold has been tanking recently, and many analysts, including a recent report from Bitwise, speculate that even a small percentage of capital flowing from gold into Bitcoin could have an outsized positive impact on its price. Fundamentally, the long-term picture is also bolstered by positive on-chain data, with Bitcoin reserves on exchanges hitting a 6-year low, suggesting investors are holding for the long haul. Furthermore, new Layer 2 solutions like Arcade and Botanics are launching on Bitcoin, massively expanding its utility and DeFi capabilities. So, the market is caught in a tug-of-war between the technical damage from the recent crash and a slew of powerful, fundamentally bullish news. Now, let's see how this all translates to the daily chart. Here is that spectacular run-up to the all-time high near $126,000 on October 6th. This was immediately followed by a brutal rejection, culminating in this massive red candle on October 10th, the flash crash. Notice the massive lower wick that extends all the way down to $103,310. This established a critical support zone that bulls needed to defend. And they did just that, as we saw the price successfully retest and bounce from this area again around October 17th. This defense created a potential double bottom pattern, which is often a strong signal of a market reversal. The subsequent rally was powerful, driven by that positive Fed news, and pushed us right back into the action zone above $110,000. However, and this is crucial, look at yesterday's candle for October 21st. Price pushed all the way up to $114,150, but it was aggressively rejected and sold off, closing the day as a bearish shooting star candle back at $108,441. This is a clear warning sign that significant selling pressure exists overhead. So, the daily chart paints a clear picture of a battleground. Bulls are defending the $104,000 support zone, while bears are firmly in control at the $114,000 resistance. The price is now coiling in this range, which typically happens right before a major, decisive move. Let's zoom into the 1-hour chart for a closer look at this recent struggle. Here we can clearly see that aggressive rally to the $114,150 peak yesterday, followed by a very sharp and sustained sell-off. For the last 18 hours or so, we've been in a clear short-term downtrend, printing a series of lower highs and lower lows. Price decisively broke below the key $110,000 level, which has now flipped from support to immediate resistance. Right now, we are consolidating and attempting to hold support in the mid-$108,000s. If we lose this level on the hourly time frame, it would signal a continuation of this bearish momentum, with the next stop likely being the $107,500 area. Drilling down to the 15-minute chart shows us the most immediate price action. After the drop, the selling pressure has eased over the last few hours, and we're seeing the price go sideways right around the $108,400 level. This is a classic consolidation phase, as both bulls and bears gather strength for the next move. For short-term traders, a reclaim of the $109,000 level would be the first sign of a potential bounce. Conversely, a break of the recent local lows around $108,300 would likely signal that another leg down is imminent. So, pulling back out to the daily chart, let's put it all together and talk strategy. The long-term bullish scenario remains very much intact due to the strong fundamental catalysts we discussed. For this to play out, bulls need to defend the $108,000 level and begin reclaiming $110,000 as support. The true confirmation for a continuation of the bull market would be a decisive daily close above the recent high of $114,150. If that happens, it invalidates the current bearish structure and opens the path for a retest of the $120,000 region and beyond. Given the strength of the Fed news, I place a 55% probability on this scenario, especially if we see spot ETF flows turn positive again. Now for the bearish case, which is currently dominating the short-term trend. A continued failure to break above $110,000, followed by a loss of the $108,000 support, would be a significant warning. The ultimate confirmation for the bears would be a daily close below that critical support zone at $104,000. If that floor breaks, a move down to the major psychological level of $100,000 is highly likely, and the bearish analyst targets of $90,000 or even $80,000 come into play. The technical damage from the initial crash is still weighing on the market, so I'd assign this a 45% probability. So, let's quickly recap the most important price levels you need to be watching. Our major support zone is between $103,500 and $105,000. Below that, the key psychological support is $100,000. The current battleground and minor support area is between $108,000 and $110,000. Immediate, strong resistance is at $114,000 to $115,000. And the major upside target and resistance is the previous all-time high region from $122,000 to $127,000. Looking ahead, keep a close watch on macroeconomic data like the upcoming non-farm payrolls report and any further comments from the Fed regarding quantitative tightening. Most importantly, monitor the daily spot ETF flow data. A return to consistent net inflows would be a powerful signal that institutions are buying this dip. And that wraps up our analysis for today. Please remember, this content is for informational purposes only and is not financial advice. Cryptocurrency markets are extremely volatile, and you should always do your own research before making any investment decisions. Thanks for watching Explain the Charts. If you found this helpful, please hit the like button, subscribe for more in-depth analysis, and we'll see you in the next video.